You don't want to miss this episode. You know all those objections you see in social media posts? We put something about infinite banking. We're going to take those objections and break them down today. Hi, everyone. Welcome to Control and Compound with Darren Mitchell. I'm your host, and joining me today is Christina Wyatt, wealth coach at Control and Compound. Hey, Christina, how are you?
Hey, Darren. I'm doing awesome. How are you doing today?
I am doing great. Excited about this topic. Before we get started, can you let our listeners how to follow and like us?
Absolutely.
Please follow and like us.
Yeah. If you're listening on your favorite podcast platform, make sure you subscribe and leave that 5-star comment. And if you're watching or listening on YouTube, make sure you like, subscribe, and hit that bell button so you always know when new content is coming out. Also, don't forget to follow us on our social media channels at Control and Compound on TikTok and Instagram.
Okay, Christina, let's get into this. So yeah, we get objections sometimes, little comments and stuff. Not a lot when we're meeting with people, but online people sometimes can just post some things. And anyway, some are constructive. Sometimes like, yeah, that was a good point. And sometimes they're just, well, frankly, they're just mean, right? and always like, who says those mean things? Like, all right, something about the content, but I'm like, we're just regular people, right? I mean, everyone on a podcast, they're just regular people. But then some people like to get their hate on and oh, you're a horrible person, and you look funny. But today we're not going to address those ones. We're going to address the objections of infinite banking,
the important ones.
Yeah. So let's start with the first one. Infinite banking is a scam. I love this. Yeah, it's a scam. All those banks that put billions of dollars, all the wealthy people, business owners and real estate investors, they fell for it. It's just a big scam. Well, scams and gimmicks usually don't last hundreds of years. And whole life has been around in Canada since Canada was born. So the entire time Canada's been existing, whole life's been there. So I think it's pretty hard to have a scam or a gimmick when it's 200 years old, when the wealthy people use it, when the wealthy families in particular have used it, corporations have used it, the Walmarts, the Disneys. I mean, it just goes on and on. It's just a comment it's almost too crazy to respond to, but what's your take on it?
Yeah, so I want to refer people back. We did the podcast episode not long ago where we responded to Dave Ramsey. So he is probably the ultimate infinite banking is a scam. This is that's his approach to it. So we did do. So if you if you're listening now, you want to go back there. We go into detail and kind of go through each point one by one. But like you said, whole life has been around forever. So there's that product, and then there's the strategy or the concept, right? So infinite banking is a concept, and you do have to take some time to learn it. And some people don't want to learn it. And if you don't take the time and put in the effort, we meet with people for hours at a time going through this stuff and making sure that you fully understand it. If you don't take the time to learn something, you're never going to understand it, and you're always going to fear it, and you're going to think that it's a scam. If I don't understand something, I don't truly believe it either. So you got to take the time to, learn more about it. And you will see, like you said, it's been around for hundreds of years. There's many wealthy individuals doing it. It can't possibly be a scam. Like, the scams go on this long? Like, usually they catch them in a week and we read them in the news, don't we? Like, it should have been out there by now.
Bernie Madoff got away, 10, 20, 30 years or whatever. But yeah, I mean, to say it's a scam, I look in Canada last year, the 4 companies we deal with paid $2 billion in dividends to the policyholders, or paid $2 billion in dividends, which grew the cash value and death benefit of Canadian policyholders. Like, there's not a scam that's paying out $2 billion a year now, 200 years after it started. Like, so yeah, let's move on from the scam one.
And go back if you want to hear more of us. If you want to hear us, go through it a little bit more, definitely go back and check out that podcast. We go more into that. But let's go on to our next objective.
All right. So the next one is you lose the cash value when you die, or the insurance company steals your cash value when you die.
Yeah. And this one kind of comes from, you've seen people throw up pictures and they're like, this is what it looks like. Here is your $1 million death benefit. Here are your cash values growing. And that $1 million death benefit stays the exact same and never changes. So I don't know what product that is. It's probably Universal Life or something like that. But that's not the product that we use for infinite banking. So huge misunderstanding here where people think that their death benefit is going to stay the exact same as the day one purchase, never move up, and never include any of those cash values and that additional deposit that you're putting in there, right?
Yeah. And I mean, like, if you think about it, like, they steal your cash value when you die. Like, there's a lot of different insurance companies. You'd think one insurance company would say, hey, maybe if we don't steal your money when you die, we could sell 100 times more, and we could point out that all these other insurance companies are stealing your money when you die. Like it's just ludicrous. And even like on Universal Life, not that I like to stick up for Universal Life all the time, but there's Universal Life products that say you could start with $1 million and you could pay premium every year and your death benefit will never be more than $1 million. They call that face. And then there's Face Plus, where you pay premium in and it grows your cash value. So if your cash value is 100,000, you get paid $1 million plus the 100,000. Okay. Well, those are two different products, and the premium going in are two different things. There's no smoke and mirrors. This is all contractually actuarial calculated to say, which product do you want? And to say you lose the cash value, all you got to do is you run an illustration with no overfunding and then overfunding, and look at the death benefit. The death benefit's going to be significantly higher if you overfund it. So you're not losing the cash value.
Yeah, and just kind of break that down as well. Like if you're sitting down and looking at an illustration for a correctly designed infinite banking policy, you're going to have a couple columns there, right? You're going to have your deposit column, you're going to have your cash value column, you're going to have your total death benefit column. So I emphasize total there because that death benefit is made up of a few different things, and it continues. You will see it grow every year. If it's not growing every year, it's not designed correctly. It is not an infinite banking policy. Get out now. It's not what it says it is. But if it's designed correctly, it's going to continue to grow. I was doing a client review the other day and we looked at the death benefit where it was. And when we looked at the breakdown given to us by the insurance company, the breakdown has the death benefit where we started. Then it has our paid up additions, which are purchased by the dividend each year. And then it has your additional deposit options, which is really that secret sauce that, creates the infinite banking policy. And it breaks it down for you right on that screen. So, it's a combination that makes up the death benefit. It's not just going to stay there stagnant and not grow at all. That wouldn't be great. And we wouldn't design a policy like that, right? So definitely a misunderstanding when it comes to that cash value side of things. And I think it's hard to wrap your head around when you're looking at it. But if you, break it down into different segments, you can understand it a bit better.
Yeah. And we go through that every time we have a education session with a new client. We break it down and say, this is exactly how it works. So it goes back to dealing with experts in this that understand it, right?
Yep.
Okay, so the next question we've got, or objection we get is, why would I pay money, or why would I pay interest to borrow my own money? Why would I pay interest to borrow my own money? Well, you're not borrowing your own money. If I have $200,000 of cash value, Christina, okay, $200,000 sitting there, and I say, I want to borrow $180,000 to go buy a 4-unit, 6-unit apartment building, and I need that for the down payment. Okay, if I borrow 180, use it as a down payment, the bank will say, sure, we don't mind you use that as a down payment, just as an aside. But if I borrow 180 for my 200,000, how much cash value do I still have?
You still have that 200,000.
So I still have $200,000 of cash value, and I have $180,000 of the insurance company's money over here taking advantage of this real estate opportunity. I didn't borrow my own money. My full $200,000 stayed in the policy. I borrowed $180,000 of the insurance company's money, and I did this deal. I've multiplied my money so it's in two places, but my $200,000 is still completely in my cash value, completely unaffected by that loan. So I'm not borrowing my own money.
Exactly. You've got that uninterrupted compounding in there. And when you think of it from, a side of things of using somebody else's money, which a lot of investors tend to like to do, if I am borrowing at 5% and I'm making 15%, I don't have a problem spending that 5% to make my 15, right? And that's kind of the way that you have to look at it. The other objection I think that you get though, that's in the early years, right? Because we want to make sure we're out there investing the and asset. But in the later years, you hit retirement and you're like, okay, well now we're not investing. So how does this make sense now? Well, at this point in time, you're borrowing against an increasing asset. So because, again, we're not using our own money, we're borrowing the insurance company's money, our money is still growing consistently inside this policy. Whereas others in retirement start spending down their assets. So, you have 500,000 or so and you spend 100,000 in your investment account. Well, you're making returns on 400,000 now, right? Well, if you borrow against your policy and you're 500,000, continues to increase. Now it's 600,000 next year. You're making returns on 600. So that is why it makes sense to do it in retirement, right? We are borrowing against an increasing asset versus, withdrawing from a decreasing asset. Who's going to end up on top here? We've done the math, and I know who wins. I know who wins.
Okay. Great response. Okay, now let's talk the next one. It's just a high commission product for the agent. Okay, so this gets in, infinite banking concept, and the product we use is a participating whole life product. But whole life as a vehicle itself sometimes gets a bad rap. And I'll be honest, when I was first starting out in the financial services business, I hated whole life because sometimes I'd see that's back in the 90s when people would knock on doors and go in and help families at the kitchen table, that old classic insurance stuff. Well, if the family had $100 to spend every month on insurance and that advisor went in and sold them a whole life with a $70,000 death benefit because there's great cash value in 30 years, that was a horrible thing. It would drive me crazy. And I'm like, no, that family deserves term insurance or should have term insurance because, if the husband dies and the wife stay at home and has 3 little kids, a $70,000 death benefit means crap. A $500 million term is a way better product. So in that case, the term insurance was a way better product. But that's not what we're talking about when we talk about infinite banking. We're talking about infinite banking. We're talking about someone that wants to save money. I mean, usually at least $5,000 or $10,000 a year of savings before we even talk to them. So that was the wrong product selection. But from a commission standpoint, the way we design it, Christina, it's not a high commission product, is it?
No, but I will be completely transparent though. We get paid a commission. Like we do.
Absolutely.
We don't work for free. You guys are absolutely right. We don't work for free. We get an upfront commission. Year one, the insurance company pays us a commission. It's not out of pocket from our clients. It's paid by the insurance company as a commission. But if it's designed and structured properly, that commission is it's a good commission. Don't get me wrong. Like we make a living doing this, but if it's structured and designed correctly, it's not a high commission that is, bad for the client. You know what I mean? Some advisors out there structure these poorly, and I'm going to give you a tip. If you're sitting down with an advisor and they show you an infinite banking policy that is only minimum funded and they haven't talked about maximum funding at all, they are selling it for the commissions. Absolutely, that's what's happening. And this is what's giving us a bad name, right? So make sure we get paid a commission on that minimum funded amount. And anytime you're talking to us, if we've ever talked to you about, we're always looking for the smallest death benefit to create that minimum amount for you. That's the game plan when we're structuring these. So yes, we get paid a commission. Do we pick the product and pick the structure for the commission? Absolutely not. We're always designing these in our client's best interest and for the cash value's interest. That's what we're doing. So good tip there though. So guys, if you see that minimum and that's the only thing on your sheet, you're not doing it right.
Yeah, and it just goes back to common sense too. Like to maximize the cash value for the insurance company to give the client a much higher cash value than a regular product. Well, there's got to be a give and take somewhere, right? They can't give the client all this extra cash and then still give the advisor this super high comp. There's got to be a give and take. And the take here is the commissions to the advisor on a properly structured infinite banking policy are much lower than a traditional insurance policy. Therefore, there's higher cash values. It's like, again, goes back to common sense. Let's jump into the next one, Christina. It's like, why would I invest in this participating whole life product? I can get a much higher rate of return elsewhere. And I always say to people, I sure hope so, because we don't think this is going to be your highest rate of return. Not even for a second do we think this is going to be your highest rate of return. I believe the highest rate of return you're ever going to receive is when you invest in yourself. You are the greatest asset and greatest investment you're ever going to be. You, business, real estate, that's where your highest rate of return is going to be. But we're really talking about a savings plan here. It's where do you save your money or where do you store the wealth you have now? And it's a very competitive rate of return, let's say 3.5% to 5% tax-free long-term, very competitive rate of return, tax-free rate of return, keeps pace with inflation, plus it's that and asset that we always talk about. Every other place you want to save money is an or asset. Do I put money in a TFSA or real estate? Do I put money into real estate or coaching? Well, this is an and asset. I'm going to put my money in here, earn a competitive rate of return, and I'm going to multiply that money, borrow against the value, and go do something else. So if I can earn a higher rate of return, say 20% over here, well, instead of just doing the 20%, why don't I do the cash value life insurance and the 20%? And now I have my money doing two things and I have a death benefit. So I would agree it's not going to be the greatest rate of return, but it's going to be the ultimate place for you to save and store your wealth before you multiply it to redeploy it into you, business, and real estate.
Yeah, and even if you are like, I have sat down with individuals that are like, I'm going to go out and I'm going to sit down, I'm going to do analysis, and I'm going to compare the returns from the stock market, my recent stock returns over the last 10 years versus this. And I'm like, I'm going to stop you right there because I can tell you right now that those returns very well could have done more. They really could. Like, don't put your time into it. You don't need to do that. I will tell you that, yes, if you're a good investor and you're good in the stock market and you're watching things and doing them well, you certainly can make a better return. That's not what we're comparing here, right? We're comparing it's a savings account. And what if I told you I could give you 5% after-tax rate of return and you could get those stock market returns, right? Like, you can do both. You don't have to pick just one. This is just where we start, right? So comparing the returns it's apples to oranges, right? It's not apples to apples. So there's no point in sitting down and doing it. I can save you some time. You don't have to do the calculations. You can get it, you yourself, your business, stock market, if you're good at it, all of those things, you can definitely make other returns elsewhere, but that's not what this is for.
Love it.
Thanks for listening so far. If you're watching on YouTube, make sure you like, subscribe, and hit that bell button so you always know when new content is coming out. If you're listening on your favorite podcast platform, please leave a 5-star rating and leave a review and subscribe. And if you are interested in learning more, please visit our website at controlandcompound.com to sign up for a free education session with one of our wealth coaches.
Okay. So, Christina, I'll let you go first on this one. So, dividends are just a return of an overpayment.
Yeah. So dividends they're classified as that with CRA. So it's a return of premium with CRA, but we like that. I like that wording. You know why? It makes it tax-free. So that wording in itself creates these tax-free dividend payments that go into your insurance policy, right? So yes, that wording is correct. But you like that wording from a CRA perspective.
Yeah, it's funny, it's we joke in the office, like, if a person that's struggling financially sometimes, or a person that's not willing to learn comes in, they sometimes have these objections like, oh, it's just an overpayment. You lose your cash value? Oh, I could get a better investment elsewhere. And I find the wealthier people we deal with, they're coming in and they don't get hung up on the word insurance or the word, is it classified as a premium or a dividend or a return of premium? They look at it and go, I don't give a crap what words you use. If it grows my cash value tax-free, never have to pay tax on it again, I can access it tax-free, it dies tax-free, it leaves a big bag of money for my estate to keep all these properties in my business and the family. I can leave a legacy. If I can do it all that, you can call it anything you want. So I think sometimes we get caught up on the words, because at the end of the day, call it a return of premium, call it a dividend. Well, because they charge too much and then they pay you it out at the end of the year. Well, what does Home Depot do? Home Depot charges more than the cost of goods, and at the end of the year, if they have money left over, they pay a dividend to their shareholders. Well, it's kind of like the same as the insurance company. Yeah, great, they're going to build in a profit or charge a little extra, and at the end of the month or the end of the year, if the actuarial assumptions were right, there's going to be extra money there, and they're going to return that to you in the form of a premium or dividend. Who cares? It's money coming back to you in a tax-free nature. Call it anything you want. It's tax-free. I'll take it.
Yeah, for sure. And I think another easy way to prove that this is incorrect is if you look at your cash values, through the years, they're going to exceed the deposits and the premiums that you put in there. So if that happens, it can't be a return of premium, right? It's not possible. Otherwise, they'd be staying no bigger than what you've put in there. So any well-structured infinite banking policy, you're going to outweigh your premiums or your deposits sooner than later, and you're going to see that happen.
Perfect. Okay. We got the next one. I watched all these infinite banking videos online and YouTube, and I did all this stuff, but it can't be done in Canada. Infinite banking can't be done in Canada. It's just for the U.S. Well, I'm going to let you in on a little secret. I believe the infinite banking concept is actually better for Canadians than it is for Americans. Now, that's a pretty bold statement. I know. I believe infinite banking is better for Canadians. Well, let's think about a couple things. What's your number one wealth destroyer? Your number one wealth destroyer that's going to erode your wealth is tax. So one of the advantages of infinite banking concept, just one of them, is the tax-favored nature of it. Grows tax-free, access it tax-free, die tax-free. Well, if we compare the tax rates to the U.S. and Canadian market, on average, a individual that makes, a couple $100,000 a year, they're going to pay a lot more tax in Canada on that income than they would in the United States. They're going to pay a lot more tax on the growth of their portfolio. If you earn $100 of interest income in a bond in Canada, you're going to pay a lot more tax than a $100 bond earned for an individual in the U.S. So if we're paying more tax in Canada, and infinite banking can allow us to eliminate that tax on the growth of the funds, we're eliminating a bigger number than our American friends. Therefore, it's better for Canadians. So, it's not the exact same in the U.S. and Canada. There are some slight differences and, different companies we need to deal with. But the concept is the same. The product is very similar. And I would argue it's even better for Canadians than Americans.
Yes. So the answer to that question is yes. Yes, we can do it. Yes, we can.
Okay. If you want to bring it down to, just bullet
Very
point,
easily.
yes.
Yes, we can do it.
Okay. So the next one is whole life is too expensive. All right. We get that one occasionally. Let's break that down. Let's use an example. So if it's expensive, then it's like an expense. An expensive is an expense. So let's talk about, let's pretend a family gets all their annual pay, one lump sum, and they get it in cash. So a family earns $100,000, they get $100,000, and they got to pay out some money from that. So they pay thousands of dollars to the power company, hydropower, to get electricity. Then they pay thousands of dollars for car insurance, home insurance. Is that money an expense?
Yeah.
Yeah. How is it an expense? Well, at the end of the year, I know I paid that bill, and what do I have to show for it? Well, nothing. I have no account balance at the end of the year. That's just an expense. Now, what if that family takes some of that cash they get paid and they buy gold? Is that an expense?
No. That is not an expense.
You have an asset at the end of the year, something to show for it. If you change your mind, you have this hunk of gold that has value. What if I put $2,000 a month into a savings account? Is that an expense?
No.
That's just a place I'm saving money. Well, what if I place $2,000 a month into a high cash value life insurance, which is a savings account on steroids with all kinds of other bells and whistles that come along with it, and I build up a cash value that I can cancel and take back, I can leverage 90% of it, I can allow to grow tax-free? Is that an expense?
No. That is that is not an expense.
So people are like, oh, it's expensive. How much money do I need to put into this policy? And I always tell people, I go, nothing. You don't have to put anything into this. This is a savings vehicle that's going to allow you to become, I think, a lot wealthier long-term, build a strong base, all the wonderful things we talk about. We don't have to put anything into it. But I look at this as my opportunity fund because I'm building up cash value life insurance. It's guaranteed to go up every year. And when the market crashes and real estate crashes and Bitcoin crashes, it won't crash. Man, I'm going to take advantage of a lot of opportunities. So when I tell the people, if you think of it like an opportunity fund, how big do you want your opportunities to be? Well, I want to take advantage of big opportunities, so I want to fund my cash value big time so I have more cash value in there so I can take advantage of bigger opportunities. So I think is it expensive is the wrong way to look at it, is what are you getting for the money you put into it is the better way to look at it.
Yeah, and I think that where people come from on that side of things goes back to that story that you were talking about, the family at the kitchen table that should have purchased the term insurance, right? So that comparison to expensive is going back to term insurance. That really is an expense. Term insurance is an expense, but we need it, right? We want to make sure that we protect our families, but that absolutely is an expense. You don't see anything from it. And when we're looking at purchasing death benefit, you want to go with the, sometimes you need to go with the cost-effective nature of term insurance. So the whole life policy isn't for everybody. And we say that all the time. If you're looking at insurance as an expense, then you might be looking for term insurance. You're not looking for a participating whole life policy for your infinite banking. This is not the right strategy for you. You need to get your term insurance first. And we tell people that all the time when we're speaking to them, that it might not be the right fit for them because right now they've got to go take care of their debt. They've got to buy some term insurance. They got to take care of some of those fundamentals first. Once they're ready to start saving and building up that, savings account on steroids and taking advantage of those opportunities, then it's time to start looking at infinite banking. So from some people's point of view, I guess it could be expensive, but that's because you probably should be purchasing term insurance, right? Like it's not the right strategy for you. And that goes straight back to that kitchen table where people are selling the wrong product and putting all of these objectives out there. It's that very well, term insurance could be right for you. This might not be, and that's okay. Like get that term insurance because it's important for you to have it. We want that protection just as like protection comes first. We always make sure that we're talking to our clients about that. And the infinite banking comes with that participating whole life, which is right for the person that's getting ready to save, wants to grow their wealth and take advantage of those opportunities. And I think that's a very important point is that, the expensive thing goes out the window when we're not talking about expenses anymore.
Yeah. I mean, again, the expensive nature of it. Well, okay, to commute to work, Christina, you could have bought a bicycle for $500, but you bought a Tesla. Okay, the Tesla cost more money, but it can do a lot more than the bicycle can.
Yeah,
and we live in Halifax. Trust me, in January, I don't want to see Christina coming into the office on a bicycle. Okay, so it's like apples and apples. So to say it's expensive. You're right. Maybe term insurance is right for everyone. We tell people all the time, it's not the right time for you for an infinite banking policy.
Absolutely.
And again, I'll be honest, as an advisor, it feels good. I had someone the other day, they wanted to put all their money in an infinite banking policy because they were ready to buy a house and they wanted to then borrow the money out. And I'm like, whoa. You don't want to do this now. You're going to have less access to money. This isn't the time for you. And he's like, well, what do you mean? Like, well, no, this isn't the time for you. You need to get some term insurance in place, and we're going to build up your savings to get to a point that we're going to start an infinite banking policy. But it's not the time right now. So, if you want to call that too expensive for him, well, I just say it was a wrong product for him at that time. He wasn't ready.
Yeah.
So unless you're able to save money every single month or every single year, you're not ready for the infinite banking concept.
No.
Okay. The next one we have is, but when I put my money inside the insurance, I can't pick my own investments.
Oh, no.
Oh, no. I say, thank goodness. Thank goodness. It's like, okay, so you think you can decide where the money should go, and you're going to know better than the insurance company that's been doing it for 100, 200 years, has never missed a year, never not paid a dividend, consistently done it. Professional money managers will figure that out. I mean, that's, good. There's all kinds of studies. If you can... Consumer behavior, they always pick the wrong things, right? What do? We buy high and sell low. Market drops, everyone panics, and you want to buy. So, I mean, that's on the investment side. But I want to step back a little even more is picking investments inside an insurance contract, to me, sounds like you're trying to get a really high rate of return, right? And this isn't an investment. This is a savings vehicle. So when you compare to which investments, you have to remember you're not going to be picking the stock market inside an insurance contract. Maybe it goes up 20%, but what if it drops 40%? Everything inside a whole life is designed to be strong, stable, bulletproof, that foundational savings plan. It's not designed to get 100% return. It's designed to get consistent returns for the last couple of 100 years, tax-free rate of returns, and all the other bells and whistles. But to compare it to another investment or want to pick your own investments to try to get a higher rate of return, you're just adding volatility and risk there. And that's for your investment side. This is for your saving side. We want strong, stable, safe investments inside the whole life fund, professionally managed.
Yeah.
Comments?
Yeah, I think absolutely right there. Like there's billions of dollars inside of these whole life policies. I don't really want people's emotions picking that either, right? I don't want that. This is a very, very large fund.
I heard doggy coin is good. Can we buy some of that?
No, we're not.
What?
No. So I think how it's, and if you look historically at the returns, they've done very well. Like we're talking 150 years worth of data here, right? So they've done well. If you want to pick your own investments, that's cool too, because really you could borrow against this policy and go out and invest in the stock market again, like we talked about. If you are a very good savvy investor, you can do that. If you do want to pick, there's products out there that are designed for investing in the market where you get to pick those. Universal life policies. We have that podcast where we talked about the differences between universal life and whole life. It's a product. It's got its own, qualities. Can it be used for infinite banking? Absolutely not, because we don't want a negative 20 in our whole life policies, right? Like this is where we save our money for our real estate and our opportunities. I don't want a down day when the deal of a lifetime happens, right? I don't want that down day. So I do think it's a good thing that we don't get to pick our investments, but they are readily available. That's one thing some people say, well, I don't even know what's in there. We sit down and we go through everything that's inside of that participating fund with our clients. So you absolutely can go online. You can pull the profiles. You can see all of their returns. You can see exactly where they're invested. They have objectives for where they need to have different asset classes and stuff. This is not all willy-nilly. We don't know what's happening. Like we do know what's happening and it's working very well. Like why would you mess with something that's working well? Anyways, I don't know.
Yeah. I know you got a 200-year track record. All the wealthy people, banks, business owners do it. But you know what? I think I'm a little bit smarter than them. So I'd like to pick my own investments. If so, you're probably not a good fit for us. And again, like back to universal life, if there's other places you want to play that investment game, have at her. You got to think of this as a savings plan, strong, stable, leave it to the experts. Okay, everyone. I want to wrap up here. And so we heard some objections. And I think what Christina and I were trying to convey is, some of these objections are, a little misconstrued in the sense that they're valid if you put it in a particular circumstances, like whole life wasn't the right choice for those people we talked about that should have had the term. Okay, so you can call it expensive, you can call it whatever. Same as some of those, cash value and stuff. It's like you can twist it, but at the end of the day, if an infinite banking policy is right for you, all these objectives go away because we can sit down and show you what it means. If infinite banking concept is not right for you, then yeah, you might be aware of some of these things. But if it's not right for you, you shouldn't be considering the infinite banking policy at all. So, there's no objection here, I think, that would ever stand up if we sat down and talked to someone who was consistently saving money, wanted to grow their family's wealth, wanted to save for the long term, wealthy for the long term. We can handle every single one of these objections on a one-off basis. If it's not for you, that's great. Don't do infinite banking. But if you're willing to learn and you're willing to allow people to educate you on these topics, then I think the people we deal with, once they understand the product, these objections go away, and we get nobody asking us in year 1, 2, or 3 at a policy review any of these questions because they fully understand the product because they went through the process. Thanks for watching. Thanks for listening. Have a wonderful day. Thanks for listening to this podcast. If you're listening on YouTube, please like, subscribe, and hit that bell button. If you're listening on your favorite podcast platform, please leave us a 5-star review and subscribe. And if you want more information, check out our website, controllandcompound.com, and you can sign up for an education session with one of our wealth coaches.